Hello, welcome to my channel today. This is a King's Tutor. It's the first time of joining us. Thank you for joining us, okay? And if you are a returning subscriber, also thank you. Please ensure you like, comment, subscribe to my channel, okay? Now today we want to look at manufacturing accounts, okay? We want to see different aspects of manufacturing accounts. Now before we look at manufacturing account, now what is manufacturing? Okay, manufacturing, which is also known as what? The production. And manufacturing refers to the transformation of raw materials into finished goods. Okay, so the transformation or the conversion of raw materials in their raw state into finished goods that is acceptable by what? Consumers. Okay, now there are most firms that pass through this stage, that get their product at the raw material stage. They ensure they convert them. They move them from raw material to work in progress, and from work in progress to finished goods before they are being sold to outsider. While there are also most firms that get their products when it is already finished goods before it is being sold to outsider, before it's being sold to the consumer. Okay, so any firm that starts from the first stage of converting those raw materials to finished goods first before it is sold to outsider, prepare what we call a manufacturing account to get and know their cost of production. Okay, while other firms will just buy in terms of purchases, okay, in order to sell. Okay, so the manufacturing account is an account prepared by firms that are involved into conversion of raw materials into finished goods. And the reason why this is prepared, or the reason why they prepare the manufacturing account, is to know the cost of goods manufactured, to know the cost of goods manufactured, or to know the cost of production. Okay, so that is what manufacturing account. Okay, so that's also one of the reasons for preparing manufacturing account, and one of the objectives to know the cost that is ascertained in terms of the production of the goods. Okay, now let's see different costs that are aligned to manufacturing account. Different costs. Now we can call it as divisions of cost. Divisions of cost. Now, cost basically in terms of manufacturing account can be divided into we call this direct materials, direct material, direct labor, and direct expenditure. Now all this gives what I call the prime cost. Okay, now I will explain this one after the other in details. Okay, why? If you add the prime cost plus other indirect manufacturing expenditure, or what we call factory overheads, if we add it together with the prime cost, it will give us what we know as the cost of production. Okay, what is known as the cost of production, or the production cost. Now if you add the cost of production plus other expenses like the selling expenses, the administration expenses, the distribution expenses, when you add it together, it will not give what we call the total cost. Okay, now from the direct material, the summation of all this gives the prime cost. Why? The prime cost plus the indirect manufacturing expenditure, or what we call the factory overhead, add it together, it gives what we call the cost of production. Why the cost of production plus all these other expenses is called the total cost. I will explain them one after the other. Now, direct materials. Now, what are direct materials? Okay, let me start from the prime cost. Now, the prime cost refers to a total summation of all direct expenditure. The prime cost refers to the total expenditure, the total of all direct expenditure. That is, the total of both the direct material, the direct labor, and what? The direct expenditure gives what we call the what? The prime cost. Okay? Now, what is direct materials? The direct materials are the amount that are spent, the amount that is spent in getting raw materials that is used in what? The production of goods. Okay? Now, direct materials or all direct expenditure here relates to those expenditure that can be what? Traceable to a particular production unit. Okay? They can be traceable. You can actually trace them. For instance, in terms of direct materials now, if our firm is in the production of, let's say, juice, fruit juice, and it takes 2 oranges to make 1 juice, for instance, now if 1 orange costs 100 naira and another one costs 100, it means it costs what? 200 naira worth of oranges to make 1 juice. Now, to make 2 of these, it will cost 4, which is what? 400. So you see, that is direct material. Now you can trace it to a particular production unit. That is knowing that when you have 2 of these juice, definitely you incur 400 worth of what? Materials. Okay? So direct materials are the cost of raw materials that are incurred that can be traceable to what? A particular production unit. Okay? Another one is the direct labor. Now, direct labor are the money paid to, the wages paid to labor that are involved or that are engaged in what? The production of these goods that can be what? Traceable. For instance, if there are laborers that worked here, okay, you can effectively what? Trace their what? Their production, their expenditure in terms of the wages paid, because it will be paid as regards to what? The output that is being produced. Okay, so that is direct labor. Why direct expenditure are other expenditure that can also be traceable. For instance, royalty. Now we've talked about royalty account. We have royalty account in our channel. Please check in a playlist, okay? Or I'll drop it here where I've talked about what? Royalty. And show you look at that. Now, royalty is an example of direct expenditure. That is the money that is being paid in order to what? To get a lease of a land from the owner. For instance, now if you pay royalty, it means that the number of production that you get, you are going to pay per one. So you can trace that expenditure. So all this expenditure, materials, which is raw materials, wages, and other expenditure that can be traceable to a particular production unit, the summation of all them is what we call the what? The prime cost. Okay? Now, there's also, if we have expenditure that can be traceable, also we have those that we can't trace. We also have expenditure that cannot be traceable. Okay? Now, those expenditure that cannot be traceable can also be called indirect manufacturing expenses or factory overheads. Okay? We also have, it can be summed up to factory overhead. We have some like depreciation of plant and machinery. We have factory rent. We have factory wages. Okay? These are items that cannot be traceable to a particular production unit. Okay? So, adding the prime cost plus indirect expenses, it gives the cost of production. The prime cost plus the indirect. That means all direct material plus indirect expenditure gives what we call the cost of production. Okay? Which is the essence of the manufacturing account. Okay? Why the manufacturing account plus other expenditure that relates to to selling this item. Okay, these are the items that comes under the trading profit or loss account, the expenses. For instance, the selling and administration, the selling expenses, administration and distribution expenses. Okay, why all these expenses, addition of it to the cost of production gives the total cost of the firm. Okay, so this is basically the introduction part. Now, there's what we call the work in progress. It's what we call the work in progress. Now, basically, like we said before, Now, once a firm is being involved in a manufacturing account, now the firm will have to get raw materials. Okay? The firm will have to get the raw materials. Now, they will process it from the raw materials down, there's what we call work in progress, down to what we call the finished goods. Now, the aim of every firm is to get to the finished goods. That's the aim of every firm. That is why most firms, instead of getting to start from the raw materials, they only purchase items at the finished goods level and sell to other consumers. Okay? But there are some firms that want to incur and start from this before they get to this part. So as at a given date, definitely we would want to know how much cost of an item when preparing a manufacturing account. So definitely there are some items that might not be at the raw material stage anymore, and they are not yet finished goods. Those items is what we call the work in progress. Work in progress. Now, what is work in progress? They are partly finished goods. Okay? The work in progress are what partly finished goods. That is goods that is not yet at the raw material, that is not at the raw material stage, and that is not yet at the finished goods. They are in between. Okay? These are partly finished goods. So most time we'll normally have both the opening and the closing stock of the work in progress. And to adjust that, in order to involve that in the manufacturing account process, we have to deduct the closing stock of work in progress from the opening stock. Now we are going to see that in our format. Okay? So from this now, this is definitely the divisions of the cost. From the direct material, submission gives the prime cost. The prime cost and the indirect manufacturing gives the cost of production. The cost of production plus other expenditure gives what we call the total cost. Okay? So that is that on that. Now let's see the layout of the manufacturing account. How does manufacturing account looks like? So basically the format of manufacturing account starts from the manufacturing section down to the trading profit or loss account. Now let's look at that. Okay? Now let's prepare the format of the manufacturing trading profit or loss account. Okay? So definitely the same way we'll prepare our trading profit or loss account, but in this one it involves the manufacturing section. Okay? So it always starts with opening stock. Opening stock of raw materials. That is what you start with. Please take note, they're going to give you three aspects of opening stock most times. Opening stock of raw materials, opening stock of work in progress, and opening stock of finished goods. So you start with opening stock of raw materials. The next item is to add purchases of raw materials. You add it, then you add carriage inward if there is any. Add carriage inward of raw materials. You add it, and once you add it, now you have also less closing stock of raw materials. And look how we're starting with the raw materials. So once you less closing stock of raw materials, now this is cost of raw materials available for use. Okay? Now the next one is cost of raw materials consumed. Okay? Now at this point now, we can now start adding other expenditure. We'll start to add the direct expenditure. So one of the direct expenditure can be direct wages. We have direct wages here. Another one can be, if we have any direct material, you add it here. Then another one can also be, if we have royalties and expense. It's an example of a direct expenses. We add it. Now if we add everything here, now it gives us our prime cost. Take note. adding everything now gives us our what? A prime cost. So the next aspect is the factory overhead. The factory overhead. And the factory overhead comprises of all indirect expenditure. So you can start hearing something like factory rent and rate. That is here. You can hear depreciation of plant and machinery. Now, depreciation of plant and machinery in this account does not go to the profit or loss account. It comes here, okay? Now, we can also hear other things like the factory power. Factory power, you add it. You can hear factory lubricant. You can add it. Then we can also hear factory insurance for the workers there. You can add it. Then we can have indirect wages. You add it. Then we can also have fuel and power. Fuel and power. So every indirect expenditure should be added here. That cannot be traceable. So once you add everything, we'll bring it here. So you add it with this. We'll have this here. Okay? So the next thing now is our opening stock of work in progress. Okay? So we'll say add. We have opening stock of work in progress. Have it here. Then you less closing stock of work in progress. And once you less, the value it will give you, that will be here, is the cost of production. Is the cost of production. Okay? Now, since we have cost of production here, now at the right hand side, to ensure it balance, so we also have cost of production brought down. Cost of production the same amount, so that this and this will give the same amount, cost of production. Okay? So that is the manufacturing account. Now, the continuation is the profit or loss, the trading profit or loss account that is added to it. So look at how, if there is space under, we can continue. So look at how it will be the same way we prepare our trading profit or loss account. Okay? So we'll now start with opening stock of finished goods. Opening stock of finished goods. Okay? Now, remember in our trading profit loss account, instead of adding, we're supposed to add purchases. But here now, this firm is involved in manufacturing. So what we'll add is the cost of production. Okay? So we'll say add costs of production. So we'll add cost of production. We have this here. Now, the next one is less closing stock of finished goods. Less it. We have an item here. Then this is our sales. Remember? Sales. If there is return inward, you also less there. So we'll have here as so our sales, if there is less return inward, you less it. There is none. So the sales minus this is now cost of goods sold. So sales minus cost of goods sold will give us our gross profit. Carry down. Okay? So So you add this, so we have this here and this. So our gross profit carried down will be brought down here as gross profit brought down. Okay, now we can now put other expenses, office expenses, like discount allowed will be there. We can put carriage outward. Carried outward will be there. Now we can also put salaries. Salaries will be there. We can also put commission. We can put salesman salary. Okay, so the gross profit, when you add all these expenses, the gross profit minus expenses will either give us a net profit or a net loss. When here is greater than here, you have a net profit. Okay, so we can also have here as a discount receive and other income that can be added. So this will now be our net profit if the credit side is greater than this. So if we add this, this becomes our account. So basically this is the format of the manufacturing account, from the manufacturing section to the trading profit or loss account. So most firms that we are conversant with, they start this where we start from, because they buy at the finished goods aspect. Or any firm that starts from the manufacturing, we have to prepare from here up to this point. Okay, now let's see a question on how to solve this. Don't go anywhere. Please ensure you like this video, subscribe and share. Thank you very much. See this question. Now it says the Kings Nigeria Limited are manufacturers, and the following are their records for 31st December 2020. Okay, so we have the sundry debtors 12,650, sundry creditors 9,820, a purchase of raw materials 29,470, factory lighting and cooling 2,885, bank balance 71,316. Then we have stock on 1st January 2020. So these are the items for stock, the opening stock. Raw materials 5,360, work in progress 4,972, finished goods 16,295, factory insurance 1,820, rents 21,600, cash in hand 3,751, capital 296,180, office insurance 550, sales of finished goods 141,661, drawings 2,500, returns on raw materials 1,373, bad debt 729, stationery 1,586, plant and machinery 225,066, returns of finished goods 1,493, provision for bad debt 308, factory wages 13,582, stock on 31st December 2020, raw materials 8619, work in progress 3664, finished goods 11,570, furniture 38,420, selling and admin expenses 2174, office electricity 1569, bank loan 75,000, office salaries 9629, delivery van 5695. Now additional information: interest is due on loan 5%. Now II, 1/3 of the rent is to be allocated to factory. III, provision for bad debt is to be 2% of the debtors. IV, depreciation for plant and machinery 2.5%, delivery van and furniture 5%. Required to prepare the manufacturing trading profit or loss account and the balance sheet as at that date, which is 31st December 2020. So we want to prepare this manufacturing account. Now what do? Now we are going to prepare the adjustment first. Okay, I've said that before. Whenever you want to prepare a final account that have adjustment, we prepare the adjustment first. And we have done adjustment in this video. Please check in my description or check up here, okay, or you check in my playlist. You'll see adjustment of final account. Okay, watch that. That will give you an understanding on this, on the final adjustment. Okay, so the first one, the first adjustment, it says interest is due on loan 5%. It means they collected loan, but it was not paid. That's the interest. So we have adjustment. Now I have interest. It's a 5%. That's 5/100 times. Now let's check the value for loan here. The value for loan here. Bank loan 75,000. So we have 5% of 75,000. We give us 75,000. 3,750. 3,750. Okay, that is the interest they're supposed to pay. So this amount will go to the profit or loss account as expenses and the balance sheet under current liability. 2, the next one, 1/3 of the rent is to be allocated to factory. So we have factory rent. They want it to be 1/3. So it is 1/3 times the total of rent value. Okay? So the total of rent value is 21,600. 21,600. So 1/3 of 21,600 gives us 7,200. So 7,200 is the factory rent. Okay? So the completion of that, it means 21,600 minus this will give us 14,400. 14,400 is the office rent. Office rent. Okay? So why this one calculated becomes the factory rent in case we are posting. Okay? Now the third one said provision for bad debt is to be 2% of debtors. Provision for bad debt is to be 2% of debtors. Now we have provision for bad debt. So 2%. So we have 2/100 times, what is the debtors figure? 12,650. 12,650. So 2% of 12,650 will give us 253. Now let's check if there is a provision for bad debt before. Now there is provision, that's the old provision. So this is the new one, 253. Now the old one is 308. So it is a difference that we post. 308 minus 253 will give us 55. And this 55 is the decrease. Okay? Because this is the old one and the new one reduced. So it's a decrease. And this is the amount that will go to profit or loss. Okay, as income. While the one that was calculated will go to the balance sheet. So that's a provision for bad debt. And the next one is depreciation, plant and machinery, 2.5%. So we have 4. We have depreciation, 2.5%. Now this is a mixed fraction. If we convert to an improper fraction, it's 2 times 2, 4 plus 1. That is 5/2. That's 5/2. Let's say 5 divided by 2 is 2.5. 2.5 over 100 times. What is the amount for plant and machinery? The cost for plant and machinery. Okay? The cost for plant and machinery. That is what we will use to do that. That is 225,066. 225,066. So that is 225,066. So we have 562 approximately 7. 562 approximately 7. Okay, so the next one, this is the depreciation. The next one is for delivery van. So we have delivery van. Okay, it's for plant and machinery. Next one is for delivery van. They said it's 5%. That is 5 over 100 times. Where is the cost for delivery van? 56,925. So we have 56,925. So 5%. That is 56,925. Will give us 2,846. Okay? While the last part is furniture. The furniture, also 5%, as 5 over 100 times. What's the value for the furniture? 38,420. 38,420. So we have the 5% of 38,420. So we have 1921. Okay? So we have 1921. So that is the adjustment. Now let's prepare the manufacturing account proper. So we have manufacturing, trading, profit, or loss account for the year ended 31st December 2020. Okay, so if we do that, we'll have something like this. Okay, so the first item we'll have is our opening stock of raw materials. So I'm going to check here. Look at the opening stock of raw materials, 5,360. 5,360. Okay, and the next one we said add purchases of raw materials. So the next one is to add purchases of raw materials. Okay, so we have purchase of raw materials. Whichever one we have done, let's tick it. So purchase of raw materials. So we have 29,470. So this is 0, this is 3, this is 8, this is 4, this is 3. Okay. The next one, let's check if there's return outward. So let's return of raw materials. So we have returns here of raw materials as 1373. So we are returning, we are lessening it. Okay, though it wasn't in the format, but it is important. The same format of return profit and loss account. We let's return outward. So that was not good. 34,830 minus 1373 equal more. So we have 3,3,4,5,7. Okay. So the next one we have less closing stock of raw materials. So if we have closing stock of raw materials, which is this, closing stock of raw materials. Okay, so this returns. Closing stock of raw materials is 8619. 8619. So minus 8619. So we have 24838. Okay, so at this point now, we are going to add all the direct expenses. Now we're going to check if there's direct wages, direct materials. Okay, direct wages and direct material. So we are going to check if we have factory wages. Factory wages is direct wages. Okay, so don't get confused because of the word factory there. So we have factory wages. So we have factory wages as 13,582. So no other direct expenditure there. So we have 13,582 plus that we have plus 24,838. So we have 38,420. 38,420. Okay? Now that becomes our prime cost. Okay? Now let's go to factory overhead. The factory overhead. Now one of the things you will see in the factory overhead is the depreciation of plant and machinery. I said that. So we have depreciation of plant and machinery. Okay, so we have 5,627. 5,627. Okay, so the other item there is let's see, lighting and cooling. Let's check from here. We have another one, factory lighting and cooling. So it should come here at factory lighting and cooling. Okay, as 2885. 2885. So another one, I'm going to check there. So we have factory insurance. So we have factory insurance. Factory insurance is 1,820. 820. Now we're going to check if there's any factory stuff there. So, okay. So remember they said that we have to allocate this to factory rent. So we have factory rent. Factory rent as 7,200. Okay. So we have factory rent of 7,200. Okay. So once we add it with what we have here, so this is plus 5,627 plus 2,885 plus 1,820 plus 72. So we have 55,952. 55,952. Okay. So the next thing is to add opening stock of work in progress. So we said add opening stock of work in progress. Add opening stock of work in progress, which is 4,972. That's 4,972. So that's plus 4,972. Okay, 4,972. So we have 6,924. 6,924. Okay. Now we say less closing stock. Closing stock of work in progress. Of work in progress. Closing stock of work in progress is giving us 3,664. 3,664. So that minus 3,664 becomes our cost of goods produced, which is the essence of preparing that. Okay, so this will give us 57,260. 57,260 becomes our cost of production. 57,260. So we have cost of production. Cost of production 57,260. Okay, so that it balances at 57,260. So that's the manufacturing account. And let's go to the trading account and how can post item there. Okay, so let's go to a trading account. Please ensure you have written this part. Okay, sure you have written this part so it won't get confusing. I'll start posting. Okay, so continuation, we have, for the finished goods, we have opening stock of finished goods. So we have it here, 16,295. 16,295. So we say add cost of production. Add cost of production instead of purchases. We have said that before. 57,260. 57,260. Okay. Plus 16,295. So we have 73,555. 73,555. Okay. So the next one we have at the right hand side are sales. Okay. So let's check for sales. Sales of finished goods 141,661. 141,661. Okay. So since there are no other items, I'll just less closing stock of finished goods. Okay? Let's closing stock of finished goods, which is 11,570. This minus 11,570. We have 61,985. 61,985. So this is our cost of goods sold. So sales minus cost of goods sold give us our gross profit. Okay? So we have this minus 141,661 is equal to 79,676. 79,676. Okay? So when you add them together, it should give you 141,661. So we have 141,661. Okay? So we have gross profit carried on. So it is brought down here as gross profit brought down as 79,676. Okay? Now the other items there are the expenditure. Okay? So we are starting from above to see the expenditure here. So it's not expenditure here. This is not expenditure. Now rent. Now they say we should allocate rent to factory and both for office. Now we did the adjustment. We have turned that for the adjustment. So we say for the office rent is 14,400. So we have office rent 14,000 is 14,400. Okay. Now, if you check here, we're supposed to less return inwards. So we did not less return inwards of finished goods. Look at it here. Return of finished goods 1493. Okay. So we have to less returns of finished goods. So we have 1493. So this minus that will give us 141,661 minus 1493 equals 140,168. 140,168. So 140,168 minus 61,985. So we have 78,183. 78,183. So here it becomes 78,183. Okay, so that's office rent. Now we'll look again what we can see that can relate to our expenses there. Now the next one is office insurance. So we have office insurance. There was no adjustment there. So I have office insurance 550. Okay. The next one, after office insurance, we can put in our bad debt. So bad debt are 729. Okay. So another one is stationary, 1586. 1586. Another one is provision for bad debt. We did adjustment. So we said the provision for bad debts, the reduction will be posted in income. So reduction of provision for bad debt. You can rewind this video to check it. Reduction of provision for bad debt. When we did the adjustment, we said there was reduction. So it is the difference we are posting, which is 55. Okay? 55. So the next one, next expenses, selling and admin expenses. So we have selling and admin expenses. Selling and admin expenses 2174. Okay. The next one is office electricity. Next one is office electricity. Office electricity. Office electricity is 1569. Okay. The next one is office salary. $9,629. Okay. The next one are depreciation. Depreciation for delivery van and for furniture. We did the adjustment. For delivery van, the adjustment is 2846. 2846. And for furniture, it is 1921. 1921. And also, our accrued interest. The accrued interest. Okay, the interest that was accrued, we also did adjustment as 3,750. Okay, so let's check if there's any other expenses we have not included here. That's what you do. You start afresh to check. Okay, so we'll start if there's any other expenses that is supposed to come there that we have not included. Rent, cash in hand, office, drawings, returns, stationery, returns of finished goods, provision. We've recorded factory wages, we've recorded that. Okay, so interest, we have done that. Office rent, we have done that. Provision of bad debt, we have done that. Depreciation, we've done that. So we've recorded every item. So it is left now to add. So if we add up, 78183, 78183 plus 55 gives us 78238. So if you add all this, the expenses will not be up to. So our net profit will not be the total of this subtracting these expenses. So it will give us 78823 minus that will give us 39084. 39084. So this is 78238. So that is our manufacturing account. So you see, we started from the manufacturing and completed that onto the trading profit loss account. So this is how it will look and appear thus. Okay, so let's prepare, they said we should prepare both the manufacturing and the balance sheet. Now let's prepare the balance sheet in order to record this. Now let's prepare the balance sheet in order to record this. So we said the Kings Nigeria Limited, so call it balance sheet as at 31st December 2020. Okay, so we'll have here, our fixed asset. So this is cost, this is depreciation, and this is net book value. Okay, so financed by, okay, so we have financed by. So let's start from the left hand side. We're supposed to have capital here. So let's check if there's capital in this question. Capital is here, 296,180. 296,180. So we have add net profit. Now the net profit we got from our profit or loss account. So the net profit there is 39,084. 39,084. So if we add it, we have 296,180 plus 39,084, 335,264. Okay. The next is to less drawings. Now we're going to check. Look at drawings here. Drawings is 25. So if we less drawings minus 25, we have 332,764. Okay, now this is all called capital owned, but we're not doing that now. So we have our current liabilities. So current liability, we can have creditors here. Let's check if we have creditor. Okay, there is sundry creditor as 9820. Okay, let's check other ICAN that can come here. Now we have accrued interest. That's accrued expenses. Interest on loan that was accrued. That's 3,250. We also have bank loan. We have bank loan. Look at it, it's on 5,000. Okay. So those are the items that will come there. So the next one, the right hand side, let's check our fixed asset. The first one is the plant and machinery. What's the cost? Plant and machinery cost 225,066. 225,066. Okay. So if we just abbreviate it, because of space, plant and machinery, 225,066. Okay. Now the depreciation, we calculated depreciation on it. So the depreciation will be is 5,627 as a 2.5%. So we have 5,627. So cost minus depreciation will give us the net book value minus 5,627. This will give us net book value as 219,439. Okay? And the next one is delivery van. Delivery van, the cost of delivery van, 56,925. 56,925. Now the depreciation, we also calculated that. Depreciation is 2,846. That's 2,846. So 56,925 minus 2,846 will give us 54,079. Okay, that's delivery van. And the next one is furniture. Okay, now furniture, the cost for furniture is, look at it there, 38,420. So 38,420, and the depreciation, we've calculated it as 1921. Okay, 1921. None of them had previous depreciation, so there is no accumulated. So 38,420 minus 1921. So we have 36,499. 36,499. So if we add up all this now, 36,499 plus 54,079 plus 219,439, this will give us 310,017. Okay, as our net book value. So if we add all this, 225,066 plus 56,925 plus 38,420 equal 320,411. That's the cost of all the fixed asset there. And let's see that depreciation, 5627 plus 2846 plus 1921 gives us 10,394. Okay, so the cost minus depreciation is giving us that. Okay, so now let's go to current asset. And the current asset we have here, now we'll have to check our debtors. Okay, and the debtors value is 12,650. Now let's check. We calculated provision of bad debt. Okay, now the provision coming here, bad debt, the provision coming here is the one that was actually calculated, not the difference now. And it's 2% on this, the one that was actually calculated, which is 253, which is 253, so that we can know the actual debtors balance. So 12,650 minus 253 is 12,397. Okay, so the next one we can get here is our bank balance. So the bank balance is 71,316. Okay, the next one we've used all this. The next one is cash in hand. So we have cash in hand. So you see how to do it. You take it so you know the actual one that is remaining. Cash in hand, 3,751. So we'll check. We've done sales. We've done stationery. We've done this. We've done this. Okay, that's all. Now it's remaining the closing stock. Remember, the closing stock will also appear here. Okay, so we have stock, the closing stock. So we have stock for raw material. Stock for raw material as 8619. We have stock for work in progress as 3664. We have stock of finished goods as 11,570. Okay, so when we add up all this, I think that's all. There's no other thing remaining. So we'll add up all this, 310,017 plus 12,397 plus 71,316 plus 3751 plus 8619 plus 3664 plus 11,570. We have 421,334 at the right hand side. So the other one, we have, at the left hand side, we have 332,764 plus 9,820 plus 3,250 plus 75,000. Okay, the accrued interest, is 3,750, not 3,250. Okay, so if we calculate 332,764 plus 9,820 plus 3,750 plus 75,000, so it will give us the same as 421,334. 421,334. Okay, so that is how to prepare that on that. Okay, so that's how to prepare the balance sheet of the manufacturing trading profit or loss account. Okay, so definitely we've seen how to prepare the manufacturing account from scratch. Okay, we've seen the different aspect of cost and the format, and we've seen a question on how to prepare this. And that's the first way a question can come. Now, another way manufacturing question can come is what we call transfer pricing. Okay, what we call transfer pricing. Now, this relates to a situation whereby the supposedly cost of the item in the market might be higher than the cost of what production they incur. Okay, so when this happens, when they value it in terms of the amount it is in the market, so most time the firm might want to value their production in terms of the market value. Okay, they want to value it in terms of the market. So when they do that, most time they may either have a difference between the actual production cost and the supposedly market value. So that difference can either be a gross profit or a loss. It's a gross profit on manufacture when the market value is higher than the production cost they incur. Okay, so why it is loss when the reverse is the case. So when this happens, you'll be given a transferable net realizable value, okay, or a market value that they are valuing the production cost. So when this happens, you credit the manufacturing account, okay, and you debit the profit or loss the trading account. You debit it. Now becomes the purchases that will be added to opening stock of finished goods. Okay, so let's see an example on how to solve this. Okay, don't go anywhere. This is very important. Let's see an example on how we can solve this when we are given a transfer price or a net realizable value. Let's see how it looks like. Okay, let's look at it. Let's see an example on that. Okay, let's see the question that relates to the transfer pricing. It said the following was extracted from the books of Kwame Enterprises for the year ended 31st December 2005. So we have stock on 1st January 2005 as manufacturing goods 9,740, raw materials 3,000, discount allowed we have 3,740. We have depreciation on plant and machinery 13,000. Printing and stationery 930. Purchases we have manufactured goods, carriage inward, we have debtors, cash at bank, purchase of raw materials, office rent and rate, repairs to machinery, plant and machinery, factory electricity, carriage inwards. For raw material, we have office salaries, we have carriage outward, general expenses, factory rent and rate, cash in hand, manufacturing wages. We have sales, we have capital, we have creditors, we have traveling expenses. Now the additional information, stock on the 1st December 2005, manufactured goods is also known as finished goods, okay? So 27,940, raw materials 2,000. Now goods manufactured, now take note of this. Goods manufactured are to be posted to the sales department at net realizable value of 271,500. Net realizable value of 271,500. That is what the value of the goods. Now in most questions, they will say it is a market value. Okay, so that's what the transfer price. Okay, so this is the value, this is the amount they are valuing the goods that they will manufacture. Okay, but most time the goods, the actual goods cost might not be the same with the transfer value. So at that point, they may either have a gross profit on manufacture that will be added to the gross profit on trading account. Okay, so we're going to prepare that and see how it is prepared. So the first thing, remember, is our opening stock of raw materials. So we'll have it here, opening stock of raw materials as 3,000. So we have 3,000. Now we have add purchases of raw materials as purchase of raw material 87,260. 87,260. So this is 06. This is 2. This is 0. This is 1. Now we also have add carriage inwards. Carriage inwards of raw material. Now let's see if there's carriage inwards. That's 3,410. 3,410. So we have 0, we have 5, we have 7, we have 6, 3, and the 3,670. Okay, so we are also going to check if there is return outwards. If there is none, then we'll check less closing stock. Less closing stock of raw materials. Now the closing stock of raw materials is 2,000. Okay, so we have 0,761 91,670. Okay, so that is the cost of raw materials used or consumed. Now the next other item we're going to post here are the direct expenses that can be traceable. We've seen that before. So we're going to check if there's any here. We're going to check if there is any here. Any direct. Okay. Manufacturing wages is a direct expenses. Manufacturing wages. Okay. That's 110,290. Okay, let's check again. None. So that's the only one. So once we add it, this will give us 6, 7, 8, 9. This is 1. This is 0. This is 2. So this will give us my prime cost. So let's say factory overhead. Okay, at the factory overhead, let's start. The first one we can see is depreciation of plant and machinery. So we have depreciation of plant and machinery. How much is it? 13,000. 13,000. Another one, we can see repairs to machinery. It's also a factory overhead. So we have repairs to machinery. Repairs to machinery, 2,500. So we're going to check another one. Factory electricity. Okay? 5,790. Factory electricity. 5,790. So we'll check another one. Factory rent and rates. So we have factory rent and rates. Is how much? 22,710. Another one. Okay. That's all for the factory overhead. That's all for the factory overhead. Okay, so let's add them together. Now, since there is no work in progress, They didn't give us any value for work in progress, so it becomes our production cost or cost of production. Okay, so when we add up all this, the value becomes our cost of production. So when we add up all this, it should give us 245,960. 245,960. That is when you add up everything here now to give us the production cost, 245,960. So normally, if you remember in our previous example we've seen, the production cost becomes what is posted there to balance it, becomes our purchase value, okay? But now they said they are valuing this, before now they said it should be the goods manufactured. This is the goods manufactured. It said it should be what? Posted to the sales department at this value, 271,500. So it becomes our transfer cost, 271,500. So 271,500, that is what we're using. So 271,500. Like I said before, the transfer cost, that the market value, is higher than the actual production cost incurred. So it means that they incur lesser than what is being valued in the market. So for that now, they have a gross profit. So we have a gross profit on manufacture. So what's the gross profit? This value minus this, because we are supposed to have the same value. So this is 271,500. This is 271,500. So this minus this will give us 271,500 minus 245,960 will give us 25,540. Okay? 25,540. So we start with opening stock of finished goods. Now look up, finished goods is the same thing as manufactured goods. Okay? So in case you see that in exams, finished goods is the same thing as manufactured goods. So opening stock of finished goods is 9,740. 9,740. Now remember in the previous also, notice, we're supposed to add cost of production. But since they are valuing it with a higher cost, so it becomes our cost. So we said add transfer cost. So transfer cost is 271,500. So 9,740 plus 271,500 becomes 281,240. So let's check if there's also purchase of this for finished goods. Okay, there's purchase here for finished goods, manufactured goods. So we'll say also add purchases of finished goods, 12,740. 12,740. So we have plus 12,740. We have 293,980. So also add carriage inwards. Add carriage inwards of 500. So plus 500, it will give us 294,480. Okay, that is 294,480. So we're supposed to less closing stock. So at this point now, we're supposed to have our sales at the right hand side here. Sales 299,420. Okay, so we're supposed to have sales. So I'm cleaning this part to continue up. So we're supposed to have less closing stock of finished goods. That's the one we have by adjustment. Closing stock of finished goods, 27,940. That's 27,940. Okay, minus 27,940. We'll have 266,540. Now remember, this is a continuation of what we are supposed to have here, but there's no space. 266,540. That becomes the cost of goods sold. So our sales minus this will give us gross profit carried down. So minus that becomes 32,880. So that when we add, we have 299,420. And when we add, we have 299,420. Okay, so that is the trading account. Now, the profit or loss account now will now appear to us. Our gross profit carried down will be brought down here as gross profit brought down. Just the same normal process, but just the net realizable value that made it to change. Then this is gross profit brought down. This is for trading. Now the gross profit on manufactured is an income to them. So look at it here. Gross profit on manufactured will be brought down here also. Gross profit on manufacturing account as 25,540. Okay, as 25,540. So we are going to add all other expenses at the debit side here. So the expenses, let's check from here. Now we have discount allowed here. So we are going to include that as discount allowed. Discount allowed as 3,740. So we'll come here. We have printing and stationery. So write it here as printing and stationery. How much is it? 930. Okay, the next one, debtors, no, it will not appear there. Cash at bank, no. Purchase of raw material, no. Office rent and rent. Now it is important you know what and what will appear there. Check the format. We've done that. Office rent and rates. 6,500. Okay. The next one, plant and machinery, no. Office salary. Office salaries. Office salaries is 9,400. That will continue. Carriage outward. 2,330. Okay, we'll continue. General expenses. General expenses. 3,170. Okay, we'll continue. Recorded sales. Capital no. Creditor no. Traveling expenses. Traveling expenses. 2,790. Okay, so that's the only item for that. So we're going to add now. Let's add now so that we can get our net profit. So if you add this now, it's supposed to give us 58,420. 58,420. So if we add all these expenses and deduct it from this, we're supposed to have a net profit. A net profit of 29,560. 29,560. Such that when you add it together, it should give us 58,420. So that becomes our manufacturing, trading, profit or loss account. Okay? So from this now, we've seen how when there is net realizable value, when the production is being transferred and valued at a market price. So we have to post it to the right hand side of it. Then we post it at the debit side of the trading account. It's supposed to be added to the opening stock of finished goods as seen like this. Then also the gross profit should be added to the gross profit of the trading account. Okay, so that's basically how to solve. So we've seen how to solve for a normal manufacturing and when there's net realizable value. Okay, these are the two ways a question for manufacturing accounts can come. So if you have any question, please drop it at the comment section. Please like this video. Let's get to other students and you can share. Okay, thank you very much. Please ensure you subscribe if you have not done that. Now let's see at the next video. Thank you very much.